Hi, I'm Michael Keneally and I'm one of the portfolio managers of the Pathfinder funds. I started my career in 2008 in the depths of the GFC at Goldman Sachs and have been investing since in South America and as well here in similar funds in New Zealand. The Pathfinder Ethical Growth Fund is a close replica of the KiwiSaver Growth Fund. So it's a diversified portfolio of growth assets like equities and some defensive assets like bonds. The goal is to make your retirement a bit better by delivering sound, risk-adjusted returns within an ethical framework. So this fund would suit an investor that's keen to find a fund that more closely aligns with their personal values. So we're seeking to build portfolios that generate sound, risk-adjusted returns within this ethical framework. So this suits people that would like to see their investment returns compound over long periods of time, and so that they feel good about how that money was made. So the fund typically invests 70 to 80% in equities with the balance 20 to 30% in defensive assets like bonds. Within the growth assets, we invest a small portion in private opportunities of the likes of Lodestone, who are building solar farms, and Sharesies, which I'm sure everyone's heard of. Within the equities bucket, roughly 2/3 is invested in global stocks and the balance is New Zealand and Australia. I'm the lead portfolio manager of the Pathfinder Ethical Growth Fund. We have a small but growing team with over 70 years of collective investing experience through various market cycles. The team has a breadth of experience across equities and fixed income. Investment decisions are complex and nuanced, and we're trying to build portfolios that are able to generate healthy risk-adjusted returns within the ethical framework. So we start with a detailed screen that digests over 500,000 data points, and it gives us a ranking. Think of it as a priority list for where we should focus our time. From there, we look for businesses that meet our ethical criteria, and we then pass stocks into a theme consideration bucket or a portfolio construction consideration bucket. We then start thinking about the business's fundamentals. We think about, does this business, are the advantages that this business have sustainable? Are they going to endure in an ultra-competitive world? We bias to owning long-term quality growth compounders, but we're also cognizant that we need to build portfolios that are healthy and balanced. So we do a lot of analysis to check that we're not overly skewed to any one factor, style, country, risk factor, for example. We change our mind when the facts change. So when the business's model has changed, when the opportunity set has changed, the competitive landscape has changed, or when something has appeared and it now clashes with our ethical framework, we would look to exit that investment. We try to cut our losers quickly and trim our winners very slowly with that long-term buy and hold mindset. We spend most of our time fishing where the fish are. So there are three investing pillars: the respecting people, planet, and animals. And we've identified 4 investment themes that align to those pillars. So those are healthy planet, healthy living, digitalization, deglobalization. So we try to spend most of our time looking for investment opportunities that align to those investment themes. Investing is all about taking and managing risk. So markets don't always go up, unfortunately. So there's a few ways to frame risk. Risk is losing money. Risk is also the short-term risks and long-term risks. There's some great data that shows that over the last 100 years or so, 60% of all stocks in the US failed to beat riskless assets. So what that means is that actually the first step for running money is to just avoid the losers. So we try to invest in companies that we think are robust, they've got great management, they've got great industries with great tailwinds, growth tailwinds, and we try to avoid the opposite. We try to avoid the businesses that are poorly run, that have bad balance sheets, that are in difficult and volatile industries. We also build, to manage risk, we also look to build portfolios that are positively skewed to these types of companies with enduring characteristics, as well as, and as measured by financial risk metrics, by ESG quality metrics. Risk is also about how a portfolio bounces around. And diversification is considered the only free lunch in investing. So how do we diversify? Well, first of all, as I said earlier, we have diversification across stocks and bonds, but also we go a layer up where we look at the cross correlation between different sectors, and then within a sector, we'll then think about the quality of the businesses that we're owning. We think about how to reduce risk by not owning bad quality. We skew towards positive quality, and that's on a range of metrics, a lot of financial, balance sheet type metrics, as well as ESG metrics. Risk is also about how the portfolio bounces around day by day. So diversification is the only free lunch in investing. So as I said before, we have some diversification in the fund in stocks and bonds. It doesn't work through every market cycle, as we saw in COVID times, but it is one tool, is one lever. After that, we look at the cross-sector correlations, and then we look at correlations within a sector as well. And this is all part of the portfolio construction methodology that we use to try and manage risk. As a part of that, we are trying to focus on those high-quality businesses that are lower risk, not just on financial metrics, but also on ESG metrics. The goal of the Pathfinder Ethical Growth Fund is to generate sound returns that compound into an easier retirement for you. We believe that clients, regulators, consumers more generally, will all increasingly demand businesses operate sustainably to maintain that social license to operate. If you've got a long investment horizon and you have the same view as us, then this fund might be for you.